Good morning, everybody. Welcome to Capital Gains and Principal Residence Guidelines by CRA. Understanding the tax implications is really important. Globe and Mail just reported that you may have to pay tax on some of your gains. The capital gains exemption may not include all of your property, those sorts of things. So I've included the Revenue Canada link here for you. Take a photo. Maybe you can get it off the slide presentation. I'm not 100% sure. I do this as a volunteer, educational services. Please like or subscribe or share even. There's my email if you want to talk to me about any topics you'd like to see. This is an educational video. So what are we going to talk about on the agenda? We're going to take a brief look at capital gains overall, and what is it and how do we calculate it. What we're going to focus on in this presentation, though, is the principal residence exemption, because I've been getting a lot of emails that people didn't know they were required to do this, and we've been filing not notice of objections, but we've been filing for protection and then amending the tax returns because Canada Revenue Agency wasn't looking for them, so we didn't get the penalties and the interest charges. Really important. The report that leads us into the reporting and compliance. The fines are significant. Okay, special cases, considerations, and future trends and updates in this ever-changing world in which we live. So understanding capital gains. So a definition and overview. So all a capital gain is you buy a house. You pay $250,000 for it. Okay, how do you get a capital gain? Well, you sell it for $500,000. 500,000 minus 250 is you have a capital gain of 250,000. Now, if that is your principal residence and it's not over 1.24 acres, a half a hectare, it is tax exempt. Okay, if it's over 1.24, it may be subject to tax, and we'll look at that criteria. So profits are taxable on capital gains in general. They have an inclusion rate. Right now, 50%. But what was proposed last June 2024 was an increase, and then government was prorogued, an election called. So Revenue Canada has made an announcement to defer that, and I'll give you those dates. It's really important that you grasp the capital gains because it can have a significant impact. Are you paying income tax on gains at 50%? Are you paying income tax on gains at 100%, or you're not paying any tax because it's your principal residence. So capital gains under tax, their profits from the sale of assets. Right now, only 50% of those are taxable, included in income. So if you had a capital gain of 100,000 times 50%, 50,000 would go onto the Schedule 3, and you would pay tax on that. Again, I just want to reiterate here, the government, the Liberal government in 2024 wanted to increase the rate of the inclusion rate of taxable capital gains. But then, of course, we went through a lot of political instability, pro government and election. And in all fairness, this has been deferred to January 1st, 2026. In addition, typically when legislation is changed, it has to go to Parliament. It receives royal assent. Now, what happened was when government was prorogued, Canada Revenue Agency did try to take responsibility on this and then, install that legislation. It was pretty threatening. But Canadian people made their voice known very clearly to the incumbents coming in the political arena, and thus we've got this extension, which I think is fair. Financial planning is important. You really have to be aware of the tax implications. For example, is it zero tax because it's principal residence? Is it included at 50% because it's capital asset, capital gain? Is it included at 100% because it's business? It's not capital. Okay, this can significantly affect your planning and what your future decisions are in your business and investments, personal investment decisions if you don't have a business. So these are the two calculation methods for capital gains. You have the adjusted cost base. So you bought a house 30 years ago and you paid $250, okay? You had legal fees to acquire that. You had title registration fees, whatever it cost you to get that asset livable and going, that becomes your cost base. Okay, the fair market value method, well, say you have a business and you're winding it up and you want to take assets out of the business. Well, you're going to have to find estimates of what those assets are worth and dispose of them at fair market value. Now, fair market value may trigger a loss, it may trigger a gain, it may trigger 100% taxable business income, okay? That's why the fair market value method is also mentioned. So it's really important you choose the correct method. If you actually sell, you use the adjusted cost base. But if you're transferring personally, say from a business or personally to somebody else, out of a business, or even transferring across to your children, it comes out at fair market value. And you can research, Revenue Canada does this, you research the real estate market, it's real estate, black book values, all of that. You can even research Kijiji or price comparisons with all the search engines out there. It's really easy to get this information now. So make sure you're applying the correct method. Now let's talk about that principal residence exemption. What qualifies as a principal residence? Okay, well, it's really simple. It's where you live, it's where you reside, or your common law partner, your children. It's essential for tax exemptions. You have to have lived there the ownership duration, the entire period. Okay, this has to be designated as a principal residence for the entire duration to qualify. Remember that link I left you at the front. It will help you. It'll go step by step through this. So claiming the exemption, so understanding the qualifications is crucial to successfully claiming the principal residence. Limitations on the exemption: the land considered as principal residence is limited to half a hectare, as I said, 1.24 acres. The Revenue Canada deems you have to demonstrate that you need more land than this to enjoy your home. And this can vary. And it'll go on a case-by-case basis. Conditions for claiming the exemption: ownership requirement, you must own the property to qualify for the principal residence exemption. You can't claim it for somebody else, okay? So what will happen is land title registry, it'll show. And you'll want to have a copy of your document. You get that, your conveyancing documents. It'll be in there when you originally bought the home. It has to qualify as primary use home. So if you have a house, you have a cottage, you have foreign properties, whatever, and you say you split your time between the two properties, then you might have to prorate it. And you have to sort of show for 100% your intent to reside there. We'll get into that in the special cases. And the consequences of non-complying are significant: partial or full tax liabilities, and interest, compounding, and that goes on and on until you do comply. So how does the exemption impact capital gains? Well, the principal residence, if you're allowed to claim 100%, well, it'll totally eliminate your capital gains taxes when selling your home. And if you're prorating it between properties, or because you're using a business in it part-time, or whatever the case may be, it could reduce the amount of your taxes. So the capital gains exemption, it can significantly decrease, if it's a principal residence, to zero, versus if you're taxed at 50% of the net gain, or 100% as a business. The importance of understanding exemptions: you'll need to know how it works. And that link, you can read up on it. It's easy to read. You can go through the calculations, practice, ask questions. Ask questions of your professional tax advisor. So if you liked the video, please share, subscribe. Thank you. Reporting and compliance. All right, here comes the big one. Reporting the sale of your principal residence. Okay, so this is the form. And it says here, this is the form T2921. You can't see it, it's on the bottom. It said, use this form to designate a property as principal resident. You must also complete the principal residence designation section of Schedule 3. You must. There's no choice. You do this when you disposed of, or were considered to dispose of, your principal residence or any part of it. Okay, you granted someone an option to buy your principal residence or any part of it. Interesting. Ask your tax specialist: did you write an agreement, say you're financing the sale? may deem disposal of your principal residence. Okay? Ask your tax professional. So here's the second page of the Form T2091. You have to file this form. Okay, you must. If you don't complete this, if you sold your principal residence, you're non-compliant. Now, so here's the address, property, the year of acquisition, proceeds of disposition, your name after 1981, between 71 and 82, and the total number of years. So just for example, if you purchased this house on December 2016 and sold it January 2019, it was your principal residence the entire time, enter 4 tax years, okay? Ending 2016, 2017, 2018, 2019. Okay? Says here, designate the property about to have been the principal residence for the following number of tax years ending after the acquisition date. Year of acquisition is 2016. I know it says here after the acquisition date, but you include, if it was at December 2016, it's included. Okay, so you would put the 4 years here. I wanted to give you a calculated example of what a taxable capital gain is. First of all, I'd like to recognition to Martin Castelling Notary Public. This is a real sample from Notary Public in the Vancouver area. I'm really grateful that he put a sample of this so that you guys can look at this calculation and have an understanding before you make the deal or walk in to your lawyer and wondering what's all this paper you've been asked to sign. And I did ask permission, just so you know, even though it was available on his website. Thank you very much, Mr. Castelline. We appreciate your sample document for the purpose of this presentation. So here's our sample taxable capital gains calculation. You've got principal residence, non-principal residence. So here's your selling proceeds as per this schedule. You've got 600,000. You get a recovery of your strata fees because you don't give your strata fees away that you paid to the purchaser. Okay, you're going to subtract the real estate commissions. Okay, it's two. It looks like it's 2 real estate companies, not one. So they split the commission and it's broken out separately. So then you also recover the buyer's portion of taxes and the buyer's portion and your utilities because you paid this in advance. So they pay that back to you because they're going to live in it for that term, right? Legal conveyancing fees. Now, I don't know, these are not accurate. I just put these numbers in because I didn't ask any firms. Every firm varies. Some of them, it's a percentage of the selling proceeds, that sort of thing, plus, disbursements, distribution costs, disbursement costs that may be for faxing, that may be land title registration, et cetera, et cetera. So the net sales recovery proceeds, and the net sales and recovery proceeds of this, whether you're principal or non-principal residents, okay? I hope that makes sense. Now, less the cost of your house. And I hope you maintain those documents. So what you would have had here for the purchaser, you would have had a sample purchaser statement of adjustments, very similar to the sales one beside us. And what you're going to put in there, the cost of your house, the legal fees would have been capitalized, title registration. And so there's the total cost base. This is what we would call the adjusted cost base of your home. So you're going to take your net sales proceeds less your cost base because your taxable capital gain. 2024 inclusion rate. If it's a principal residence, if you filed your T2091, it's exempt. This income, no income gets included in your tax return. If it's a non-principal residence, you're holding it investment purposes, 50% gets included on the Schedule 3. It'll automatically calculate it for you. You'll pay tax on this. Okay, unless you are considered a real estate property mogul, that you're trading business, you're trading properties and selling properties, you're flipping properties, it will be considered 100% taxable. I hope that helps you to understand how the process works. Now, here's the penalties. Failure to report the sale of your principal residence results immediately in a penalty of $8,000 for late filing. And then there's a percentage and there's a fee per month that you're late. And the interest compounds, okay? So if you fail to report the sale of your principal residence, you might be taxed 100% on the capital gain. It's really serious stuff. And the government's broke, we're in a deficit. So we really, all of us need to pay attention to this. That's why it never hurts if you're doing your taxes, have someone review them for you. So special cases and considerations, I briefly mentioned at the beginning, partial exemptions for multiple residences. Okay, partial exemptions can apply if you've got multiple residences, you're splitting your time between. Do you want to just designate one as your principal residence, affecting your tax obligations and calculations? So you want accurate tax report. It's crucial. Revenue Canada has access to all that information now. There's information that they can search and find out all your property holdings. Are you properly disclosing of them? For example, you're trying to claim a capital gains resident in property less than 365 days, you can be taxed 100%. They might consider that property flipping. It's on their website, and unless there's special circumstances, you lose your job. You're moving more than 40 kilometers away. There's a whole bunch of criteria on that, okay? And this is that, when does capital gains get complex? It can be very complex because if you're considered a trader, a regular trader, if you will, and venture in the nature of trade and business, you're going to be taxed 100%. The gain exemption wouldn't apply. Mixed use properties, what we learned from COVID is a lot of us came home, we're working remotely, but we want the best tax advantages we can, so we want to claim that home office space. Well, if you have a commercial office in your residential building, that square footage of that commercial office, maybe they're going to claim that the proceeds of the sale 100% on that. Expect that to come up. I expect that will come. Our deficit is just too large. Government needs tax dollars. And remember, January 2026, just remember the income inclusion rate for capital gains will go up. So watch for it to receive royal assent. The new budget it's been very vague what our new Prime Minister, Mr. Carney, has alluded to. And we'll see what gets passed through Parliament. Hopefully we have a real budget by Christmas. With the new government, he seems to be moving very quickly, and we can plan better. Changing residency status. So if you're leaving the country and you don't know how to do your tax returns, and that you're disposing of things fair market value, or you've sold things, please see a tax specialist. You are deemed, if you look at the change in residency status, it could lead to financial implications, tax implications, because when you leave the country and change residence status, everything is disposed of at fair market value prorated for the date and time that you left. That's the simple version. If you're not comfortable doing your taxes, if you are considering departure, please meet with the tax specialist and project what that might cost you, if anything. Okay, the tax implications. Future trends and updates. Okay, the recent changes in legislation. We know that in January 2026, the capital gain inclusion rate was supposed to take place in 2024. Been deferred, thank goodness. Right? Remember for announcements from Parliament and legislation of the capital gains inclusion rate. Watch for commercial office in your principal residence. Maybe they're going to make us pay 100% tax on that, which is fair. I mean, if I got the deductions for business, I should pay the tax on the income, I suppose. And anything else, because we are in a position where we have a high deficit. There is also talk that we'll be getting taxed on our equity. That is nothing new. That's been around for 40 years. The NDP wanted to do that many, many years ago. They tax you on your assets, less your liabilities is your equity. So watch for that legislation and how that's going to impact you and budget for that if that comes ahead. those are the potential future amendments they talked about. So real estate is continuously growing. People are trading, that's considered 100% business income. If Revenue Canada will sort of look what your sources of income are coming from and say 90% of your income is coming from trading real estate versus 10%, you're working part-time at, I don't know, you're off an office for a friend or something. And they would look at that and say, oh, okay, well, no, that's a business. That is not, you don't get capital gains exemptions on those, okay? So you really have to pay attention to what's happening out there. And I know if you don't like to watch a lot of the TV and social media is just pounding us and all the fear mongering out there, just go to the government website, look and see. It's there, okay? And if you don't want to do that, you just want to do what you're good at, your business, talk to your tax professional. So the impacts of trends on real estate market, we've really had it from 2000. We've had 8 years of just change up and down, trends that we have never seen before. So, it may be difficult to really determine, do those trends mean anything? 2017, we had fires in British Columbia, then we had floods, and then we had landslides, then we had inflation with the pandemic, record high inflation. Inflation's down now, and now we have tariffs. We have to really be resilient in these days because we just don't know what's coming next. And traditionally, Canadians were conservative, so we waited it out. So, homeowners, like if you want to retire and sell that home that's been your nest egg, you want to really sit down and look, is this a year to sell, or do I wait? Do I settle, or is it a good selling year? Considering some of the rents and that we've seen out there, can you replace your living for rent, if you will, unless you have other property for what you're living in? I mean, rents. I looked at Kerry's British Columbia, $2,500 a month. So really watch how this is affecting us. Certainly speculation. Stay the course. Don't let social media. You research your facts. Be real. Ground yourself. So in conclusion, that's it. We talked about just capital gains overview in general. I could do a follow-up if people are interested on capital gains on assets, winding on a business, those sorts of things. The principal residence guidelines. This is what this is about. The article from the Globe and Mail bothered people, and so I thought, okay, I'll present this, and this is what it means. Tax compliance is important always, especially now the government is broke, so they're going to try to take as much as possible. What deficit and yet keep the country going for ourselves, for our people. So if you like this video, YouTube, please subscribe, like, and share. And the email is on the first slide. And if you have any questions or want to see something else, by all means, drop me a quick line, okay? And if anybody wants to do a live discussion for people out there and you have a group, by all means, schedule that.